$26,000. That's roughly what an average dog's yearly costs can quietly shave off your home loan borrowing power, and some households have seen it cost well over $120,000, according to broker-reported figures. By the end of this video, you'll know exactly which pet costs a lender can actually count, how the maths behind that number works, and a simple 90-day check to run before you apply. We paired this with our own breakdown of the APRA rate buffer on home loans. That buffer stress tests the interest rate. Pet costs stress test the expense side of that very same surplus equation. Quick note before we start, this is general information only, not personal advice. Always check your own numbers with a licensed broker before you make any changes. The call was going fine until the broker asked for 3 months of bank statements and the line that looked like love started to look like a problem on paper. Pet insurance. A vet pharmacy debit. A boarding hold from the last long weekend. Ordinary household lines, but lenders read recurring cash flow, not the affection behind it. Lenders check statements because they want proof your surplus is real, not just claimed. Every recurring cost, pets included, helps them picture what's actually left over each month, not just what the form says. Honestly, this caught us off guard too the first time we looked closely at our own statements. It's an easy thing to miss because none of it feels like a spending problem in the moment. This is not banks quietly banning dogs. It's simpler and a lot less dramatic than that. They're counting spending they can actually see on a page. Choosing decent pet insurance or a good vet plan is a completely understandable, sensible choice for any household. The catch here only shows up later, at the exact moment you apply. So the real question isn't whether a bank likes pets. It's whether these regular lines are quietly shrinking the loan you thought you could get. Most Australian lenders start with something called the Household Expenditure Measure, a benchmark of modest household spending. It doesn't include housing costs, and it's not something you can talk your way under. If you write a lower living cost figure on the form, most lenders quietly use the benchmark anyway. Underestimating groceries doesn't invent extra surplus, it just wastes your own time. So the floor isn't actually where pets bite. It's the layer sitting above the floor, the part a lender can verify, that actually matters here. If your real spending, insurance, grooming, boarding, vet plans sits above that floor or gets verified from your statements, your assessed expenses go up. Higher assessed expenses mean less leftover surplus. And less surplus under the exact same income means a smaller maximum loan every time, no exceptions. And this touches a lot of us. Nearly 3 in 4 Australian homes now share their address with a pet. So this isn't a niche edge case, it's a mainstream one. So who actually feels this squeeze the most? It depends on the shape of your own application. Let's walk through it household by household. The rulebook itself doesn't change from household to household. What changes is how much surplus room each household has left to absorb a pet line before it starts to matter. 3 kinds of households feel this differently. The first home buyer near the edge, the refinancer, and the household whose pet bills arrive lumpy rather than monthly. First home buyers near the edge of what they can borrow feel this first. Every dollar of surplus is already earmarked for stamp duty, moving costs, and the first 6 months of bills. A pet line competing for that same surplus can be the difference between the home they wanted and the smaller one they end up settling for instead. The same squeeze can follow a household straight from renting into buying, because the pet costs don't reset when the address changes, only the scrutiny around them does. Refinancers feel it differently. The rate switch looks simple on the surface, but the living expense check underneath can still catch a comfortable, well-established household off guard. A clean, easy refinance can quietly stall on a review of the exact same statements that decided the original loan years earlier. Nothing about the pet has changed, only the scrutiny. One broker described helping a client with pet insurance around $400 a month and a total pet care stack close to $1,000 a month at the high end, a real if unusual case. Then there's the household that pays pet insurance once a year in one lump. That single reviewed month can look far heavier than the household's real, ongoing pattern. Here's the part that surprised us: cash purchases blur together on a statement, but a direct debit for insurance stands out clean, dated, and easy to name. So it's rarely the food bowl that gets noticed. It's the one recurring, clearly labeled line that an assessor can point to and count with confidence. And if boarding sits on one partner's card and insurance sits on the other's, A joint application still sees both once the two sets of statements are combined and read together. A household with two pets doesn't just double the affection, it can genuinely double the recurring lines an assessor sees, especially if both are insured separately. A pet with an ongoing health condition can push one household's real spending well above the average. Through no fault of planning, vet costs like ours don't always arrive on schedule. On average, ongoing costs sit around $2,520 a year for a dog and $1,656 a year for a cat, real money, but nowhere near the scary headline number. But averages don't capture every household. Some pet owners run a very different pattern to that national average, and that's exactly where the real surprise sits. The pattern that changes the picture is the broker-reported high stack. Some owners run pet costs of around $1,000 a month, not the national average of $210. That's a real reported pattern, not a typical household, and definitely not a reason to worry about your own ordinary vet bills. What an assessor counts is the recurring dollar size, not the species. Whether you're renting in a capital city or paying off a place in a regional town, the mechanism is the same. It's about visible, regular cash flow, not postcode. It changes shape again near retirement, too. A household downsizing on a fixed income can find a modest pet care bill counts for more, simply because there's less income cushion around it. Families juggling school costs and childcare feel the same squeeze from a slightly different angle. The pet line sits in a budget already stretched across several other genuine priorities. So pause on this. In your household, are you already stretching to the very edge of what you can borrow, or is there real breathing room either way, whatever life stage you're at? That question decides how much the next part actually matters for you personally. So let's put real numbers on the surplus carefully and honestly. Borrowing power is what's left over after tax, living costs, and other debts, then stress-tested at a higher interest rate than you'll actually pay day to day. Roughly, each extra $100 a month of assessed spending costs about $12,500 of loan size. At $210 a month, that lands close to our $26,000 opening number. Here's the cleaner way to see it. A small monthly habit gets multiplied across 30 years of assumed repayments, so a modest number today becomes a much bigger number in the loan size maths. Push that to the broker-reported $1,000 a month stack, and the illustrative hit climbs to around $124,000, the extreme end, not the everyday household. This is a planning sketch, not a lender's actual calculator. Your real number depends on your income, your other debts, and the specific lender's own internal rules and policies. That rough 9% figure isn't picked at random. It's roughly a typical product rate of around 6% plus the APRA buffer on top, which is exactly the next lever we need to unpack. None of this maths is meant to scare anyone off owning a pet. It's simply a tool for planning the household's application timing, not a verdict on whether the pet belongs in the family. There's a second, completely separate lever worth knowing about here, and it has nothing to do with pets at all: the APRA serviceability buffer. APRA-regulated banks must still assess your repayments as if the rate were 3 percentage points higher than what you'd actually pay, confirmed again just this year. Pets don't create that rate buffer, and the buffer doesn't create the pet effect. They're two entirely different levers, both quietly competing for the same leftover surplus. None of this means the plan is off the table. It just means the pet line belongs in the plan from the start, not left out and discovered halfway through an application. And here's the honest counterpoint. Most households with an average dog or cat still get approved every single week. This is a thin surplus problem, not a pet ownership problem. Policies genuinely differ by institution here, which is worth remembering. A pattern that gets loaded by one lender might be waved through by another with a slightly different assessment approach. Shopping around isn't just about chasing the lowest rate anymore, it's also about finding a lender whose expense treatment actually fits the shape of your household's real spending. So here's the calm version of all this, the checklist we'd actually run ourselves before applying step by step. Step 1. Pull 90 days of statements and highlight every pet-related line: insurance, vet, pharmacy, groomer, boarding, and any food subscriptions. Step 2. Total the monthly average from those highlighted lines and separate the must-keep care from the genuinely nice-to-have extras. Step 3. Ask a broker in writing which lenders on their panel actually add verified pet costs on top of the standard benchmark. A written answer from a broker becomes something you can compare across lenders later, and something you can point back to if an assessment ever feels inconsistent with what you were told. Step 4. Treat any change to insurance or care as a welfare decision first and a borrowing tactic second. Never leave an animal underinsured just for a spreadsheet win. Step 5. Declare honestly on the living expense form. The benchmark already floors a low declaration, so honesty here saves you time later, not surplus now. If your pet costs are lumpy, timing your application away from a known big annual payment is a practical hygiene step, not a sneaky one, just a sensible one. While you're at it, comparing pet insurance quotes properly can sometimes lower the monthly line without lowering the cover, a smaller, calmer win that helps the surplus and the pet. None of these steps needs a whole weekend. Most households can pull the statements, total the average, and draft the broker question in one focused evening at the kitchen table. Step 6. Rerun your surplus after the rate buffer and your other debts, cards, car, any study loan. Pets are one line in a much longer list. Write it down once and you're no longer guessing at the broker call, you're walking in with the answer already worked out in advance. Once you can see the trade-off this clearly, you're no longer guessing about pets and borrowing power, you're simply choosing with the real picture in front of you. You don't need to solve the whole application tonight. You only need the next honest number, and that's something you can genuinely find in one quiet evening. If this helped map your thinking, subscribe. We put out one of these guides every week.